Good morning, ladies and gentlemen. Well, I was hoping to talk about the possible outcomes of some coup, but it looks like we have no coup in Russia, and therefore we've got to talk about the boring week that we've had in all markets. And what can we say? The narratives are just not changing, and therefore the pricing isn't going to change until the narratives do. So let's have a look at what the narrative is and what the potential outcome will be when they do change. The current macro narrative is very much one of higher for longer, and I think it'll remain so until the data shows either the economy is weakening substantially or that inflation is accelerating. Because have a look at 5-year forward inflation expectations. They have moved zero on the week, and the Fed, with its hawkish rhetoric, is managing to keep inflation expectations just above 2%. And therefore, they're quite happy. They will continue with this hawkish rhetoric. They will continue with the rate hikes if necessary. I get the impression from various Fed speakers that they would like to be done with rate hikes, but they need cover from data. They're not getting it, and therefore they're continuing with the same rhetoric. We have PCE at the end of the week, core PCE, and that could shift the narrative, but short of events in Russia, which events are events, you can't forecast them, you can only react to them, unless this figure changes or we get a change in the term premium, a substantial change in the term premium, which will only happen in case of a change in narrative, then we are stuck where we are. All these charts, which are basically the fundamentals of what the market expects inflation to be over the next few years, or what it expects the term premium to be over the next few years, are completely stuck in very narrow ranges. And therefore, it should not surprise that the bond market and the yield curve are stuck within very narrow ranges. If we have a look at what the yield curve did over the course of the last week, we will see that at the 30s level, it moved a whole 3 basis points. At the 2s level, it moved 10 basis points, and that is entirely due to the fact that the Fed keeps on having hawkish dot plots, and Chair Powell keeps on repeating that probably 2 rate hikes this year are in order to bring down inflation further. While that keeps on happening, the yield curve can but go more negative, i.e. flatten. But I think even that is running on fumes. I've switched here to a weekly chart so you can see the differences a little bit better. This is the 2-year note. And as you can see, the ranges are getting smaller, and we're basically stuck at 475, 477, whatever that is. It really makes no difference. But you can see the shape of this chart. Basically, the 2-year note is being dragged up towards Fed funds because everyone's fed up with losing money on the negative carry. The 5s, less so than the 2-year note, right? Could we get to 406? Yes, but I think that, again, that is a decent buy for a reaction back down. The 10s, less so than the 5s, and finally the 30s, least of all. I think everything is stuck in a range at this moment, and I showed you the fundamentals, and the fundamentals say that nothing is changing, and therefore why should the market pricing change? All this does is really make the yield curve go slightly more negative. This is the 2s, 10s. But you can see at these levels, we're really running on air. And is it wise to have too much exposure when we are trading above 100? where can we get to? Yes, we can get another 4 or 5 basis points, but I think that through these Bollinger Bands, it makes zero sense to have a position on. And if we look at something like 5s, 30s, that probably can definitely fill this gap, which tells you that the 5s are more vulnerable than the 30s. But it doesn't say that we're going to get a trend. But what it does say to me is that every time the 5s drop significantly to a level that makes sense to buy them, that this curve is going to come back. It really is pick your level. This market is one where you need to be really precise in your positioning. At this 27 level, I'll definitely give it a go on the downside, but not by doing the yield curve, but by buying some 5s. And finally, if we have a look at 10s, 30s, that's the only one that I'm awaiting to put on a position which is for longer than a few hours or a day. And that is at zero in the spread between the 10s and 30s by buying the 10s and selling the 30s. But when there's little to do little, what is happening in the US curve is actually happening much faster in the German curve. The 2s are getting towards the top of their range. The 5s are going absolutely nowhere, but will probably continue slightly to go towards the top of their range. And the 10s are absolutely stuck, and the top of the range seems to be this 275, 57 area. So if we have a look at what the yield curve is doing, this is the 2s, 5s. It's flattening, and it's flattening more in Germany than it is in the US. It's probably doing it too fast, which probably means it goes sideways for a little bit. And the 5s, 10s is flattening as well. So there's more flattening in Germany than there is in the US. And that is because the ECB is still behind the curve and still will, in my opinion, hike more terminally than the Fed will. We are basically at the last 25 to 50 in the US, and we could be still doing more in Europe. And therefore, this kind of flattening is going to continue in Germany much more than it is in the US. And they're both flattening. So that is the story, and that is the takeaway. In terms of differentials between US and Germany, I am still looking at this area around 160 basis points in 5s as a sell, and I'm looking in the 10s around this 143 to 145 area as a sell. That should mark a top in the dollar, in the DXY, and then we should have another leg lower. I just can't see why these differentials should be going out more. The only reason why they would is because the ECB not abandons, but lowers its terminal rate projections. And I don't think that is going to happen anytime soon. As I said earlier, I think the ECB has more hikes in store than the Fed, in which case at these range extremes, around 145 to 150, you have to be a seller of 10s and basically wait for another drop down towards 125. The dollar last week basically tracked the interest rate differentials nearly tick for tick. So if you believe, like I do, that we are going to get to that 145, 150 level in the 10-year differentials, and top out there, that would imply that we get to around 103.50 in the dollar and top out, or maybe slightly higher. In any case, the odds seem to be for slightly higher in the dollar, maybe 1%, and then a retracement. That's all I can say. Around this 103.50 to 103.70, 80 level seems to be a decent level to expect the dollar to top out and come back down. If the differentials do what I think they're going to do, that seems to be a decent risk reward. As you know, I've been bearish of gold for weeks now with very little reward, playing it from the short side though. As long as it can't even rally to 1959 or the rallies basically top out there, you are still looking for 1881 and you're still looking to play it from the short side. The idea basically is that bonds don't go anywhere and the dollar isn't going very far, and the pressure on gold keeps on being put on it by the fact that it's a non-yielding asset. And in a period of relative calm, why would you forego earning, I don't know, 5.25%, 5.5% on short-term bills while owning gold, unless you think that inflation is going to accelerate, and it doesn't seem to be. And therefore gold is slowly getting unwound. But I don't think that below 1881 is warranted at the moment. That would be the absolute level that I cover everything that I have in terms of shorts, and I see really no reason for it to go beyond there for the time being. So little to say about DBC as well. It just can't get going. What did it do the week before? It just basically reversed this week. So we are in a huge range, remembering that DBC really is a lot of oil. It really doesn't surprise that this is the picture in oil. The daily chart basically keeps on trading between the Bollinger Bands and below these moving averages. It just can't even challenge them. It's a weak market. The top is in the low 70s and the bottom is in the mid 60s. It still looks like what I've been saying for a while, that it can get into around the 60 level of possibly 57 is possible. I do think that that is a decent buy. I just don't see that the world economy is that weak at the moment that we are going to trade that much lower than where we started the year. But the picture is one of basically rallies being sold. And while that is the picture in all commodities and DBC, it's very tough to see that inflation is going to accelerate. And therefore, it's very tough to see that bonds are going to have, a complete nightmare, or that yields are going to, in bonds, are going to escalate. And therefore, these inflation expectations that I showed you at the beginning of the video are not going to move substantially higher. And if they're not going to move substantially higher, just the threat of higher short-term rates is going to be enough to keep bond yields lower, and therefore in that case the term premia negative, and in that case the stock markets don't have that much room to go further down. So what happened last week to SPX? Well, this is a weekly chart, and you can basically see that last week it got overexcited. It closed above the Bollinger Bands, and as markets do, it just retraces that. This is purely technical. We haven't broken any significant level. The levels to break are much lower to change this into a bearish picture. And therefore, as far as I'm concerned, absolutely nothing at all has changed in SPX. We're coming up to month end this week, and therefore it pays to look at the monthly chart. It's not bearish, is it? We've broken 41.81, and unless something significant happens this week, we are basically in a new trading range with the top somewhere around these levels, which is what, 4600-ish. You know, whether it's 4580 or 4610, who cares? But this is basically your top, and then it can come back down. Nothing bearish in this. It's holding the 200 period moving average, bouncing off it. I just can't see why anybody would get bearsed up about the stock market. Can you go sideways another few months and bounce off 41.81? For sure. But to me, everything is pointing eventually further upwards, rather than that we are ready for any kind of a big down move. What we have to do is ask ourselves, why is the technical picture in SPX as it is? What is it that's making stocks go up? Well, one of the answers would be this negative and stably negative term premium. So the term premium has really declined since last year, since its peaks of last year, when it was actually at a positive level, slightly positive, and it's now down to minus 65. This implies that the market does not expect bond yields to go significantly higher, certainly not in real terms. And if that is the case, then you start getting something like this, that as soon as the E improves, i.e. the earnings expectations improve, you also get an improvement in the multiplier. It seems to be quite obvious that the market, unless the bond market moves significantly, the multiplier is not going to go certainly below 18, and it might easily expand towards the 20 area. And that gives you that 4600 level top for the time being that we've discussed on the monthly chart. So I'm trying to marry logic with levels indicated by the technicals, and this is what I'm coming up with. Now, you can believe this narrative or not believe it, but it seems to be one that's making sense. Let me repeat it. Term premia are remaining negative. Therefore, that implies that the bond market is not expecting big moves, because it's not seeing big moves in the real rates. And therefore, multiples are expanding, and the pressure from the liquidity, i.e. people who are underpositioned, etc., is one of chasing or buying dips. Therefore, the downside is protected and the upside is open up towards that times 20 level. And that is where the market is going to force the last few people to buy, and then probably remain in a very large range for the rest of the year. That is the current narrative. Let's trade the current narrative until it changes, it seems to me. I also wanted to show you this monthly chart of DJI. To me, this is very interesting. So basically, we started 2023, and we are basically now 1%, 2% away, whatever that is. It really makes no difference. But this is where we were in November, and we're still vastly below it. We just can't close above that level, which fits in with the narrative of what stocks are leading, etc., etc., etc. But what it's saying to me is keep an eye out on the DJI, and it's a close above this 34,590 level that is going to be important and give you the odds of when the whole of the stock market is ready to start going higher. I guess the DJI can't move that much because it has energy stocks, it has financial stocks, which are going nowhere. But when those bottom, that is the time to start getting bullish of the entirety of the stock market. And it's not yet. So basically, what this chart is telling me that for now, this is still a spread move of individual sectors. When this starts getting moving, then it should be the entirety of the stock market. To me, even the Nikkei did nothing wrong last week, i.e. it just worked off some overbought conditions. I'm a buyer in this range, anywhere between 31,900 down to 31,400. Risk reward is certainly to buy it there for a move back up towards 34,000. I'm still think that the Nikkei is one of my favorite stock markets, and if I can't see the SPX coming down more than I've showed you, then I can't really see the Nikkei coming down more than that either. So that is all I can say about stocks at the moment. I think at best they're in a correction. And that is it. You still have to buy the dip, it seems to me. And just finally, let's have a look at SPY TLT. This is a daily chart. We still, even with the correction last week in the stock market, we have not broken the previous high level. Everything is still pointing upwards and or stability or upwards. And if we have a look at ITOT over government, so the totality of the stock market against the totality of the bond market, that is, of course, far less immediately bullish, but it's certainly not bearish. The fact that it closed slightly below the previous high, I don't think is that significant. I think the trend is still up. To me, it indicates that it's going to trade between this kind of level, 405 up to 425 for the next 2, 3, 4 weeks. But eventually it's still going higher. And that comes back to the narrative that I gave you about term premia, about real rates, and the fact that the bond market is more or less stuck, and not to expect big things from it, and to trade the ranges. And if that happens, if I'm correct in that evaluation of the bond market, the fact that term premia are negative is just going to squeeze more people into buying the dip in the stock market or chasing the stock market. And more money is going to rotate out of bonds into equities. And I think that is the narrative that we have at the moment, barring events. But on these events, you buy the dip. That seems to be the current narrative, which is driven by the positioning that we have in the market. I've tried to keep it short and sweet and tell you what I think is going on and why I think it's going to keep on going on. With that, I've changed some of the levels, but nothing major. I still think that gold is not a buy. I still think that interest rate differentials between Germany and the US are a sell at higher levels when it reaches these levels. And that is about that. That will still continue to make people buy the dip in equities and push out the multiplier. I think it's all as simple as that, and you trade the ranges in bonds and you keep on buying dips in equities. Thank you very much indeed, and speak to you on Monday.